Good morning, everyone. Thank you for joining this James Cooper Creston webinar on the new 30-day reporting rules for UK residential property. My name's Louise Wickens. I'm a tax director based in the firm's Reading office, and I'm joined today by my colleague Karen Harwood, a senior manager based in our Newbury office. Between the two of us, we have many years' experience in dealing with individuals and their taxation affairs. We will be having a section at the end for questions if people want to pose anything as we go along. So please do post them and we'll pick them up at the end. Over the past few years, we've seen numerous changes to property taxation, the majority of which seem to have added an increased tax burden for property owning individuals. This includes the removal of the favourable wear and tear allowance for fully furnished residential properties, and more recently the restriction to the allowability of mortgage interest relief. One of the reasons why we think it's part of a government plan to discourage second or multiple property ownership, it certainly seems to be an area that's been targeted over the last few years. The webinar today will focus on the new rules for reporting residential property gains by UK residents. It's important to note that there are similar rules for non-UK residents covering both residential and non-residential property, but these rules are separate and not part of the webinar today. If anyone does have any concerns over their residence position, it's really important that they take advice so they make sure they're reporting any disposals under the new rules. So the new rules came into effect on the 6th of April 2020, so actually just over a year ago, but we didn't really see much activity at the start, specifically down to COVID, I suspect. But recently we've noticed a significant movement, and over the last few months have reported numerous disposals to HMRC. First slide, please. So what we're going to cover today: who needs to submit a return, when a return is required, how to report the gain and actually calculate the tax, penalties for late filing, amendments to returns, and how this new reporting interacts with the self-assessment tax return itself. I'll now hand over to my colleague Karen for the next section.
Good morning, everybody. As mentioned by Louise, there are different rules for UK residents and non-residents, and these, the following slides and notes are for UK residents only. From 6th of April 2020, a person is required to submit a capital gains tax on UK residential property return if they have disposed of UK land on which a residential property gain arises. So simply put, if you sell a UK property and you realise a gain, you may need to submit a capital gains tax return in addition to your normal self-assessment tax return if you prepare one. As always, there are excluded disposals where a capital gains tax return is not required, and these include transfers at no loss, no gain. So typically that would be transfer between spouses, or disposals made by charity or pension trustees, as these are not normally liable to capital gains tax. There's also the grant of certain leases for no consideration, provided they meet specific criteria. So a person includes any individual, so that's you and me. It includes a trustee disposing of trust property or appointing out trust property, and similarly an executor selling property belonging to a deceased estate. A person also includes a partnership or the partners in a partnership, but not a company, as companies are liable to corporation tax on their gain. So if you have sold a UK property that does not fall within the exclusions I've just mentioned, must you always submit a capital gains tax return? Well, the answer is yes, unless you have either not realised a capital gain, or if you have realised a gain, there's no capital gains tax liability arising. Next slide, please. This slide shows common examples of where no capital gains tax arises, and you do not have to complete a CGT return. And the most common one would be where the property has been occupied by the owner or the seller as their main residence, and any gain is covered by main residence relief or principal private residence relief, PPR relief. Alternatively, a person may have capital losses brought forward from earlier years that more than cover the property gain, or perhaps they've already realised losses in the current year, the same year the property is disposed of, prior to the property being sold, and those losses wipe out the capital gain. If the gain is small, it may be covered by the individual's annual capital gains tax exemption. And as I've said, if there's no capital gains tax liability, then there's no requirement to submit a CGT residential property return. Next slide, please. Where a tax return is required, it must be submitted to HMRC within 30 days following the completion date of the disposal, and any capital gains tax due must also be paid by this date. So 30 days, that's not really very long, especially if you've just moved house and there are so many other things to consider. Very short time limit. A couple of further points here. Where land is owned jointly, each joint owner must submit their own capital gains tax return. It's a return for an individual, not for the property. And where a person has sold more than one property on the same day, they have to show all the property disposals on the one return. So if a person sells more than one property, they will need to make a separate capital gains tax return for each date of disposal and meet the 30-day time limit from that date. And a person may be required to make several capital gains tax returns over the course of the year. Let me hand you back to Louise.
Right, so how to report the gain? Well, HMRC has set up a new digital service to allow taxpayers to make the reports when a property disposal has been made, and this capital gains tax on UK property account needs to be set up before any return can be made. What's really important to note is, in order to get this and create this account, individuals must first have a government gateway user ID and password, and it's really important that all steps are undertaken to get this process set up. Where taxpayers have agents, the agent can't do the first part of the process for them. The individual has to take the responsibility to go in and create the account. Once they've been through that process, they then get an account number, which they can then hand over to their agent, who can then take the process over and look at making the report. It's fair to say that this is actually causing a few issues in practice. We've had lots of clients struggle with setting up the service, and in particular, clients that are of an older generation have found this quite a challenge. There is, because of this, a possibility of using paper returns in certain cases. This isn't something that's been publicised at all, and it has to be specifically requested on an individual by individual taxpayer basis. But we have found that where we're phoning up on behalf of clients who are, perhaps 80 plus, the revenue have been accepting that using a digital service may not be the best result. The only downside of using the paper returns is that it's taking quite some time for them to actually be issued once requested, which, when you've only got a 30-day reporting window, is presenting a little bit of a challenge. Next slide, please. So how to calculate the tax. You've been through the process, you've got your account number, you're ready to work out the tax you need to pay. Well, in straightforward cases, this will be the difference between the sale proceeds achieved and the original purchase price of the property less all allowable costs. In more complex cases, certain reliefs may need to be calculated. We have quite a lot of examples where someone's bought a property, they've lived in it for many years, then they've met their future partner, they've bought a property together and have let the original one out. So we have a mixture of main residence relief and non-qualifying periods. The other area that's quite important to look out for is where significant improvements or enhancements have taken place to the property. Here the rules are, quite specific and quite technical. And in order to qualify as allowable expenditure, the work must meet certain tests. Mainly that it must be capital in nature in the first place. It must increase the value of the asset that the work's been done to, and it must also be reflected in the nature of the asset at the point that it's sold. So to put this in context, you've got a property and you extend the kitchen area and build a new bedroom on top. That's absolutely capital expenditure, and when you sell it, the property's still got the extension. Conversely, if you looked at perhaps a property you were looking to sell, but the roof was quite dilapidated, leaking in places, so you replace the whole roof at quite significant expenditure. Well, here, the expenditure itself won't be capital. What you're merely doing is replacing the existing roof with a new roof, and it's doing the exact same job it's done before. You haven't altered or enhanced the asset, and the only way something like that would become allowable was at the same time as putting on the new roof, you've created a dormer or something that's changed the nature of the asset. So I'd always recommend, when there's been a lot of work done on a property, careful consideration of the rules needs to take place. As Karen's mentioned, once you've worked out the gain, losses brought forward from earlier years can be deducted. Also, losses that have been incurred prior to the disposal of the property can be deducted, but you can't take account of any anticipated losses that may come into account later in the tax year. Finally, any available annual exempt amount can be deducted. Once you've gone to that, you need to work out what rate of tax to pay. So for people that earn over the higher rate threshold, this is relatively straightforward because any gain will be a straight 28% under current rules of the gain. But for taxpayers whose income perhaps falls somewhere within the basic rate band, this is a little bit trickier because part of the gain will be taxed at a lower rate of 18% and only the portion over their available basic rate band taxable at 28%. So you do need to make sure you're estimating your other income in order to work out the tax liability. And as a general rule of thumb, I would always recommend that people perhaps err on the side of caution when estimating their income, so that they're perhaps slightly overpaying on the capital gains tax they pay rather than underpay. Next slide, please. The new reporting requirement not only comes with a very short window for filing the return, there are a number of penalties that apply if the return is failed to be made within the 30-day time limit. First of all, a fixed automatic £100 penalty applies if the return is made outside the 30-day window. And then once a return is over 3 months late, daily penalties of £10 per day can be levied. And then finally, on penalties for late filing of the return, there are also tax-geared penalties of 5% of the liability arising, or £300 if higher, after the return is 6 or 12 months late. Now, with lots of properties, particularly in this area, the capital gains tax can be quite a substantial amount. And, once a return's over 6 months late, the tax-geared penalties can be significant. Next slide, please. In addition to the penalties for late filing of the return, there's also late payment interest that will be charged on any tax that's paid after the 30-day window. And in addition, if you don't pay the tax for a significant time, there are also late payment penalties, also at 5%, that may apply. And this goes back to why it's really important that when you're calculating the tax, you perhaps slightly err on the side of caution rather than underestimate, your liability, because if you err on the side of caution, you're mitigating interest charges, and you will get the tax back when you file your tax return. I'll now hand back to my colleague Karen again.
Thank you. Amending your tax return. If you have made an error or you're in receipt of additional information, it is possible to submit an amended capital gains tax return using HMRC's online service. For example, you may have used an estimate of costs on your original return and since found an old receipt where the costs were more, or perhaps if the disposal was early on in the tax year, perhaps you hadn't completed your previous year's tax return and weren't aware of an overall loss for that year available to offset the property gain. You can only amend your return in respect of events that have occurred prior to the property disposal and not after you've sold the property. So if you sell a property and realise a gain, you submit your tax return, pay over the capital gains tax due on account, and then sell some shares, realising a loss, you can't then submit an amended property, a CGT property return, and offset the loss against the property gains previously declared, as the loss occurred after the sale of the property. You do have the opportunity to amend the overall capital gains tax position for the year when you submit your annual self-assessment tax return. There is an exception to this. If you were to sell a further property and realise a capital loss, you would then be able to submit a further capital gains tax return in respect of the subsequent property disposal. And as part of this process, you would bring into account any previous property disposals and recalculate the overall capital gains tax payable. If the result is too much capital gains tax having been paid on account, this will be refunded by HMRC. There are deadlines for making amendments to your CGT returns, and you can't amend your CGT return once you've submitted your annual self-assessment tax for the year concerned. If you're not required to submit a self-assessment tax return, the time for amending your capital gains tax return is 1 year after the 31st of January following the tax year end, and this is in line with the normal date for amending self-assessment tax returns. Next slide, please. Where you are required to submit a self-assessment tax return, all property disposals should be included on that return, along with any other capital disposals made by you during the year. Any adjustments to the overall capital gains tax due are accounted for on your self-assessment tax return, and the capital gains tax payments made on account during the year are brought into account at this time. And once the self-assessment tax return is submitted, any subsequent amendments to the capital gains tax computations are then made via the self-assessment in the normal manner, and normal time limits apply. I think that brings us to the end. Back to Louise.
So to finish, I hope that Karen and I have given you some useful information to take away. You know, the high level points of the things to watch out for. Capital gains tax calculations can be complicated, especially where you've got lots of work that's been done on a property, there are reliefs to claim, or perhaps the property might be of mixed use, so part residential, part commercial. As I hope you'll also have seen, the penalties for failing to meet the deadlines can be significant, and there's also interest and penalties for late payment of tax. So it's really important that clients and individuals are aware of these new rules and take advice as appropriate. And you know, as a firm with lots of experience in this area, we're always happy to help. So on that note, perhaps we'll see if anyone does have any questions that they've raised.
Thank you both. We have had a couple of questions in, so we can just go through those now. In a complex tax calculation case where the property was the owner's main residence before it was sold, would the gain be based on an assessment of the value of the property when the property was vacated as the main residence rather than the original purchase price?
No, I think is the straightforward answer. In a case like that, how it works is you look at the actual sale proceeds less allowable costs, the original purchase price less allowable costs, and then the gain itself is time apportioned between the part that qualifies for the main residence exemption and the part that becomes chargeable for when it doesn't qualify. Does that answer the question? You have anything else to add, Karen, to that?
No, I think that's it. Time apportioned between qualifying periods of ownership.
There are rules for non-residents who sell residential property where you can look at rebasing to certain values and things, but for a UK resident individual, you work out the gain based on, you know, actual proceeds less actual cost, and then you apply the rules and time apportioning the gain. It's important to note that it wasn't so long ago that in addition to the actual occupation that was exempt, the last 3 years of ownership was also deemed to be an exempt period. This has now been whittled down over the last few years. So now, currently, it's only the last 9 months of ownership that's deemed to be, on top of actual ownership, an exempt period.
This extension to the main residence relief was brought in to allow for a delay in being able to sell your property. So perhaps they don't think it takes quite so long, or perhaps they've just restricted the relief.
Well, another one, you know, we used to have a valuable relief called lettings relief that would help reduce capital gains tax, and that was a really valuable relief to many taxpayers, but you know, mainly doesn't apply anymore.
So originally that was introduced by an extra statutory concession, and then that became legislation, and it could be worth up to 40,000 per individual. So it was valuable and was quite a shock when it just disappeared, albeit with, I think there was about a year's notice. But...
Okay, thank you. We'll move on to the next question now. What losses can be offset against a gain? Is it only property related losses rather than other investment losses, like shares, for example?
Shall I answer this one? It's any capital loss. So it's capital losses brought forward and losses that arise during the year. You can't carry a loss back, so you can't realise losses in a subsequent year and elect to carry them back, but it's any capital loss, so on the disposal of any investment or other asset.
Thank you, Karen. We've got a couple more. What if you need to get a CG34 approved? How can you meet the 30-day deadline?
Well, the simple answer is you can't. You'd have to submit your CGT report on basically what you're putting on your CG34. I don't think it's an area actually that HMRC have thought particularly about how the CG34 interacts with this 30-day property reporting rule. You know, as far as I'm aware, there's no concession if you're submitting a CG34. It almost falls by the wayside to some extent. The other point I would make in practice is that HMRC seem to be taking an awful long time to deal with CG34s. I submitted one in April last year for a non-property transaction, and after numerous chasing got my response in January 2021. So yeah, a little bit of a thorny issue, but I don't think there's anything you can do. You'd have to effectively submit the return on what you thought was the answer, file your CG34, and then amend your capital gains tax report at a later date, or deal with it via your self-assessment tax return.
Thank you, Louise. Another one, for executors or trustees, does the account need to be different from a personal gateway account they might have?
Every person needs to set up their individual capital gains tax on residential property account. So I believe I'm right, Louise, and it's a separate account in all cases. It's not.
Yeah, I don't know what you have to do if you're a trustee, though. I presume you have to set up an account as a trustee and then file it. So if you were a trustee, you would have one for you as an individual and then one for you as a trustee. But we can double check that and come back to whoever's posed that question if that would be helpful to them.
Yeah, that's Emma Stewart.
Perfect, thank you. Another one, gift aid on gifts made from sale proceeds. How does this work?
Gosh, that's I think more complicated.
Yeah. I mean, the thing is if you're making gifts to charity out of sale proceeds, it becomes trickier to work out what your overall liability is, because obviously gift aid payments increase as an individual's basic rate band. So you just have to crunch the numbers effectively when trying to calculate the tax. We're hoping that because of the problems with estimating the tax in certain cases, HMRC are going to operate a light touch with some of these penalties and things, but I don't think we've seen enough of ones where they fall into a more complex area to quite see how they're gonna take this. I mean, it can be really difficult. You sell a property in June in a tax year. Well, you've got many months to go before the end of the tax year. If you're somebody that's self-employed, has fluctuating income, may make big gift aid payments, or even pension contributions that will have a similar effect to gift aid payments, there is nothing to do than have a crunch of the numbers based on what you think your overall position is going to be and submit on that basis. And that's why it goes back to, I would always recommend that people actually are on the side of caution with these things, because otherwise you could expose yourself to a reasonable amount of interest. There are an addition also to the late filing penalties. penalties for, you know, inaccuracies if the revenue feel that you've been careless when submitting one of these returns. But again, the feeling at the moment is because it can actually be really difficult to work out the right amount of tax. We're hoping for a relatively light touch by HMRC, but that's a hope, not a guarantee. Have you got anything else to add there, Karen?
No, I think it's exactly as you say.
Perfect, thank you both. Let's just do one more. Where the gain is realised on a probate property, would you have to nominate one executor to deal with the online return, or is there an easier way to report on behalf of an estate?
I think you treat one executor as making the return, because you're making it on behalf of the estate of the deceased, who is one person, one individual. So as with trustees, the executors of one body may be made up of many individuals, but they're one body and it's one return that needs to be completed by the executors of the estate.
But one executor could register and submit the form. A bit like with a tax return for somebody that's died, you know, only one executor would sign it, not both need to sign it or anything, and it would be a similar process.
Okay, thank you. I think that's all we've got time for today. We can reply to any other questions or that queried question separately after the webinar.
Okay, right. Thanks for joining us.
Thanks very much, everyone.